Ian Greer, fellow Finsia, thank you for joining us today.
Thank you.
Ian, how do we fund the long-term pipeline of infrastructure identified by Infrastructure Australia, and do we have a sustainable market in Australia?
First of all, infrastructure funding, the bulk of infrastructure funding will be done by the government. So historically it's been about 85%, even when we did PPPs. PPPs are about 15% of the total funding. So most of it's going to be done by the government. Now what we're looking at is can you fund the other parts? Governments are still able to do PPPs. There's still a market for that. But what the people are questioning is how many infrastructure projects are coming to the market. So it's not can you fund them, but how many will come. And the next question is there a long-term financing for these projects?
Thank you. Ian, what are the different funding options available for a government to invest in infrastructure without damaging their credit rating? For example, selling mature assets to invest in new assets.
Well, that's the obvious one. If the government does a deal where it's, say, availability toll road or availability hospital, that's considered part of the government's debt. So that's not a way of getting it off. Another way of doing it is to do a toll road, such as a cash toll road or an electronic toll road, but there's no market for those type of assets at the moment, particularly greenfield ones. So the easiest way at the moment is to sell assets, and we're seeing government sell ports and electricity assets, and so there's a ready market for that, so it's a great way to do it.
Okay. Ian, what is the appetite for international financiers to fund infrastructure assets, and indeed local financiers, our four big banks? What's their appetite to take on and fund these infrastructure assets?
There's a kind of mixed appetite, and it's really about what type of financing. And the issue at the moment is you can finance infrastructure with short-term debt, so the banks are happy to do that, but that creates refinance risk in the structures, and that creates risk for the government and the users. So actually what we're trying to do here is create a long-term finance market, as opposed to can we get the assets financed. It's a long-term asset finance, and that's the question rather than can it be financed.
Yeah. So is it down to sort of our banks not being able to provide that long-term funding? Is that an issue? Or?
Yeah. Our banks in the Australian market
Yep.
typically lend at about 3 to 7 years.
Okay.
Relative to a 30-year concession, that's short-term.
Mm-hmm.
In the past, we used to have long-term inflation-linked bonds, but that's a very small market in Australia. Monoline insurance companies used to wrap refinance risk and hence reduce the risk, but those are absent. And we compare Australia to, say, the US, where you can fund long-term infrastructure very easily with long-term debt, and hence it's a big problem for Australia.
Yep. Ian, you talked about different PPP financing options today, and we've seen some poor deals done in the past. Equity versus debt mix and bank debt versus bond finance, those sort of mixes. What do you believe provides the most stable funding mix for infrastructure projects?
The most stable funding mix, it varies by project to project.
Yep.
So what we're looking for is a long-term sustainable cash flow. So every investor comes from a different market, and their market characteristics will determine what they're after. For a sustainable market, though, you should be looking for long-term investors who are going to look for a stable equity return, not for financial engineering, and for a long-term debt return that's going to be there for the life of the project.
And lastly, Ian, we've seen examples of governments building greenfield infrastructure projects, wanting to obviously sell that to the private sector once it's built. Is this what sort of pricing should the government expect to receive back for building those types of things? How long should they hold on to them?
The period of time they should hold on to them, first of all, is long enough to create a sustainable project to invest in. So the private sector is looking to, can I predict, say, the traffic on this toll road? So how long do you need the road to operate? So 2 or 3 years probably minimum for a start-up road to create that sustainable traffic that people can invest on. How much money that they can expect for it depends on how much that traffic will support. So it's a combination of how many cars will drive along it, what tolls will get the optimum traffic flow along that road, and that will then derive how much debt and equity that can support.
Ian Greer, thank you very much for your time.
Thank you.